Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Enbridge's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Enbridge owns, transports, and stores crude oil, natural gas, and renewable energy. To put it simply, it makes money by storing and moving energy through its pipelines to various customers in the US and Canada. It transports 3 million barrels of energy per day to 25 refiners throughout the US Midwest, the US Gulf Coast, and Eastern Canada. It connects natural gas to 170 million people in residential, industrial, and commercial markets. It also owns 30 renewable power facilities representing more than 4,000 megawatts of generating capacity, and has a growing presence in offshore wind in Europe. It transports 25% of the crude oil produced in North America and 20% of the natural gas consumed in the US. The company plans to produce net zero greenhouse gas emissions by 2050. They are headquartered in Calgary, Alberta, Canada, and was founded in 1949. It trades on the TSX, New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 102 billion market cap. They're trading at $51 a share, and they have 2 billion shares outstanding. We're going to look at the ticker that trades on the TSX. So all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see they have lots of free cash flow each year. It was lowest in the trailing 12 months at 1.9 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's positive and strong each year, highest in the trailing 12 months. Revenue is the sales for the company, and that dropped a lot in 2020 due to lower oil prices, but it's come back up quite a bit in the trailing 12 months to 45 billion. This is the company's income statement from Yahoo Finance. In a little bit, we're going to look at their income statement from their latest quarterly report. The top line is the revenue, the sales. Here's a breakdown of their revenue in the US and Canada. They do a good amount of revenue in both countries, but more in the US every single year. Here's a different breakdown of their revenue. More than half their revenue is from commodity sales. That's a sale of crude oil, natural gas, power, and natural gas liquids. 4 billion in gas distribution sales, and 16 billion in transportation and other services. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost of the commodities and the cost of labor are part of cost of revenue. Also depreciation and amortization. Revenue minus cost of revenue gives you your gross profit, and that's pretty consistent each year, $14 to $16 billion a year. Below that is their operating expenses, and then below that is their operating income, which was highest in 2019 at 8.7 billion. It's currently 8 billion. Below that is the interest they pay in their debt, and they do have a lot of debt, so they pay 2.6 billion of interest. And the bottom line of the income statement is their net income, which is positive every single year. It was high in the trailing 12 months due to $2.4 billion gain in other income and expenses. It was low in 2018 and 2020 because they passed through a loss in that same category. But I would just focus on operating income when I look at the income statement, because net income can be skewed by other income and expenses. This is the income statement from their latest quarterly report, and this should give us a little more detail. This shows us the first 9 months of 2020 versus the first 9 months of 2021. They did 20 billion in commodity sales, 11 billion in transportation, and 2.7 billion in gas distribution. They don't make really any money by selling the commodity. The cost of the commodity is 20 billion and the sale is 20 billion. They make most of their money from storage and transportation because it's really expensive to transport crude and natural gas. It's not like transporting clothing or furniture. That's pretty easy. It's very difficult and complex to transport oil. You could transport it by ship or truck, but a vast majority is shipped through pipeline. That means you have to build the pipeline infrastructure, which takes a lot of time and money. Revenue is so much higher in 2021 versus 2020 because oil prices came up so much in 2021 versus 2020. But their operating income is almost identical. So either they did a really good job in 2020 at managing expenses, or they did a really poor job in 2021 at managing expenses. And the reason their net income is so much lower in 2020 versus 2021 is because of this $2.4 billion impairment. An impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So maybe they acquired a business in the past and made a goodwill impairment, or maybe they impaired one of their assets, their pipelines. This is their statement of cash flows from Yahoo Finance. In a little bit, we're going to look at the statement of cash flows from their most recent quarterly report. The top line is operating cash flow. That's how much cash the company generates from its operational business. And operating cash flow is more smoothed out than net income because net income can be really bumpy due to those impairments. So you can see it's pretty consistent operating cash flow between $9 and $10.5 billion a year. So they generate tons of cash flow. That's what you want when you invest in a business, a company that generates lots of cash flow. They have to spend a ton of money in CapEx, building out those pipelines and all the other infrastructure. So they spent over $7 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And the free cash flow is the cash that's remaining to pay a dividend, and they pay a really nice dividend. They can also use that cash flow to pay down debt or buy back stock. They've been adding a lot of debt the past few years. In 2019, they added $6.2 billion of debt. They paid down $3.8 billion. So they added $2.3 billion of debt that year. They added $2.3 billion in 2020 and added $5 billion in the trailing 12 months. They also buy back some stock. They bought back $200 million, $300 million, and $300 million. So they bought back $800 million of stock in the past few years. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. This is the statement of cash flows from their most recent quarterly report. It shows us the first 9 months of 2020 versus the first 9 months of 2021. The way you calculate operating cash flow, you start with net income, that was $4.3 billion. Then you have to add or subtract the non-cash items on the income statement. They have lots of depreciation since they have so much in fixed assets. So they pass through $2.8 billion of depreciation. That's a non-cash item that brings down your net income, but it doesn't affect cash flow, so we add it back here. Income from equity investments. This is its investments in other companies. They pass a $1.2 billion gain onto the income statement, so we have to minus that out here because it's a non-cash item. Distributions from equity interests. This is the dividends it received from its investments in other companies. So we have to add that here on the statement of cash flows. That is a cash item. You also have to adjust for changes in working capital. They had a cash outflow of $1 billion from working capital. So even though they reported a $4.3 billion gain, they actually generated $7 billion of cash flow. You want to make sure operating cash flow is higher than net income. If it's not, you want to look into that a little deeper. There's two more sections in the statement of cash flows, the investing section and the financing section. This is 2020 versus 2021, the first 9 months. The first thing in the investing section is that CapEx spending. That was $5.5 billion in 2021. And the other stuff is pretty negligible. So in the first 9 months of 2021, they had a $5.5 billion outflow of cash in the investing section. In the financing section, they had an outflow of $1.4 billion of cash. They added $6.1 billion of debt. They paid down $1.9 billion of debt. Debentures are unsecured debt that are issued by the company. So for a debenture, there's no assets backing the debt. It's just a faith that the company will pay off that debt. It paid $300 million of dividends to preferred shareholders, $5 billion to common shareholders. This is the equity section of their balance sheet. They have $62 billion of equity. They raised $8 billion from preferred shareholders, $65 billion from common shareholders. They have an accumulated deficit of $9 billion. This means they paid out more money than they received. Accumulated deficit is a sum of all your prior net incomes minus a sum of all the dividends you paid. This can happen with a company that pays out lots of dividends and has lots of depreciation expenses. So even though it appears that they lost $9.4 billion historically, their cash flow may be positive historically. Let's look at the capital structure. $62 billion of equity, $71 billion of debt. They're 47% equity, 53% debt. And I gave them a WACC of 7%, which is lower than simply Wall Street and Finbox, because I thought these WACCs were too high. I made it more in line with US midstream companies. And Enbridge is the largest midstream company in North America, so I thought the WACCs on these two sites were way too high. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 109 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $97 billion. We divide that by 2 billion shares. And we get a calculated stock price of $48. They're trading at $51, so they're trading at a 6% premium. It's a sell according to the model. The average analyst projects their revenue to increase 10.5%. I grew their revenue 10.5% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 7.2%. So I multiplied their future revenue estimates by 7.2%. That's how I got their future free cash flows. I did a video on Enbridge back in December 2020 when they were trading at $41. My valuation was $50. So it's pretty much at that price right now. So I think they're trading at intrinsic value. Simply Wall Street's valuation is $69. So they're saying the stock is 27% undervalued. 11 analysts priced the American stock, which trades at $40, and the average price target was $45. The low was $34, the high was $56. This is where the stock has been trading the last 5 years. So you can see a crash right here, and then it's come back up. But it's pretty close to the price it was 5 years ago. This bottom chart is the price of oil. So there's not too much guesswork when you invest in a company like this. It pretty much moves with the price of oil. When oil crashed, so did the stock price, and pretty much every oil stock crashed. And when oil came up, so did the stock price. So it doesn't move perfectly with oil, but it's fairly correlated. If oil prices go up a lot, so will the stock price and so will your dividend. If oil prices go down, so will the stock price and so will your dividend. And they raised their dividend each year. It was 58 cents in 2017 up to 84 cents. They pay a 6.6 dividend yield. And the way you calculate the dividend yield, you can multiply the last dividend payment by 4, take that number and divide by the stock price. And they pay out 109% of their net income, 362% of their free cash flow. Dividend comes out of free cash flow, and the reason it's so high relative to their free cash flow is because they invested so much in CapEx. Over time, it can't be over 100%, but maybe in 1 year or 2 years, it might be. Their dividend is higher than their industry. Their industry is 4.4%. Analysts are projecting them to grow their dividend to 6.9%. And their beta is close to 1, so the stock moves with the market. It's gone up 22% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 40, the high was 54. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. 13 million shares have been traded on average each day the past 10 days. Pretty much all the shares outstanding are on float. 54% are held by institutions and 4% of the shares are shorted. Their employee count is up since 2015-16, but it's been pretty steady since 2018. They're at 11,000 workers. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $18,000 today. That's a 6% annual return. There's been lots of buying activity from insiders. Only one person sold. The biggest shareholder is Capital Research at 4%, then BMO, then RBC, Vanguard, and RBC Global. Let's look at their financial ratios. Their PE is pretty good at 16.4. That's better than the market median and average. PE is stock price over earnings per share. The way you calculate earnings per share, it's net income over shares outstanding. Price to sales is pretty good too at 2.3. That means investors are paying $2.30 for $1 revenue. Price to book is 1.7. They do have a lot of intangible assets on their balance sheet. 35 billion of intangibles, 33 billion of goodwill, and 2.2 billion of other. The way you get goodwill on your balance sheet is when you acquire a company for more than its net assets. They have a low ROIC of 5%. They can cover their interest payments 3 times. They have a high ROE of 10%. If you have a lot of debt on your balance sheet, you can inflate your ROE. They have a low current ratio and quick ratio. They're both below 1. They only have $500 million of cash on their balance sheet, 6.4 billion of receivables. And they do seem to be undercapitalized. They generated 1.9 billion of free cash flow in the trailing 12 months. Their working capital is negative $7 billion. Working capital is current assets minus current liabilities, and they pay out $7 billion in dividend payments, so they're short $12 billion of funding. So it looks like they're going to need some debt financing to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 45 companies in the same industry as Enbridge, and this is the average of all 45 companies. So Enbridge is a little worse in PE and price to sales. They're a little better in price to book. They have a pretty bad current ratio at 0.6. The average is 1.3. They're a little worse than average in ROE. They're a little better than average in debt. And they're the biggest midstream company in terms of market cap. The average is only $11 billion. They're $102 billion. And they do pay a higher dividend than the average company. So to summarize, I have them trading at a 6% premium. Midstream companies have always been a pretty safe investment. There are three parts of the oil process. The upstream part, which is the exploration and production, that's the most risky. Companies have to spend a lot of money to try to identify if there's oil deposits at a certain location, and if there are, they have to spend a lot of money to extract that. Usually they find the oil under the ocean, or they have to break rocks. Once the oil is extracted, then it goes to the midstream part, where the midstream company transports and stores the oil. So they do provide an important part of the process because oil needs to get from one party to another. So these midstream companies have to build pipelines in order to transport the oil. And then it goes to the downstream part, and they do the refining, so they could turn it into jet fuel, gasoline, or whatever end product. And then it goes to us. We pump it in our cars. So we're closest to the downstream part. But every part is important, and some companies do every part of the process, downstream, midstream, and upstream. They're just a midstream company. So if you're looking for a midstream stock, why not go with the biggest one? You also get a really nice dividend, and they still generate strong free cash flows each year. It was lowest in the trailing 12 months because they spent so much in CapEx. But when you spend a lot in CapEx, that can lead to greater cash flows in the future. I rank their free cash flows 5 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.